Okay, so first presentation's about to start. We're sort of on target time-wise, so to get yourself comfortable, I just need to put the next slide on. And we will welcome, hopefully, Andy Virgo any second onto as a presenter. There he goes. Okay, Andy, are you there? No, you're not there. So I'll start talking about Andy so that here he is. Andy, can you hear us?
Absolutely. Good morning.
Marvellous. You're coming through really loud in these headphones, by the way. Right, I might have to turn it down. Okay, so a little bit just on Andy, first of all, because he's actually changed his photograph, first of all, from what he normally gives us. So there's Andy. Yeah, haircut's still looking the same. Good, nice one. Okay. You should have received this today from myself. There's actually a couple of things from Lendinvest, but I couldn't get them both on this slide. So their rates guide, and plus also basically a criteria and product guide, a criteria guide as well. That's gone an email to you this morning. So grab hold of those if you've got them. A little bit about Andy. First of all, he joined Lendinvest in 2017 as a BDM, which is probably putting himself down a little bit because it wasn't just a BDM. He was a senior BDM. I think he was national sales manager, potentially. 30 years experience. I've known Andy for a long, long time, by the way. He's got 30 years experience in the mortgage industry. He supported Lendinvest's entry into the buy-to-let market, including development of its product proposition, and has assumed full responsibility for the products as a whole. And he previously worked for NatWest and Interbay Commercial and successfully operated as a mortgage broker, both for Christie Finance and in his own property finance brokerage. Pardon that noise if you heard that. That's just telling me that Windows wants to update my machine. Oh, no. Okay, Andy, apologies for this next slide because Andy changed his interesting fact, which was Andy was once a red coat at Butlins. Now, I did actually search red coat Andy Virgo, and he's lucky it didn't come up. So that isn't Andy. That's just in case anybody doesn't know what a red coat is. But I thought you looked a little bit like Andy maybe when he was younger, but maybe the hair was a bit dodgy. So, but Andy, apologies on that. So it's over to you. Andy, buy to let in 2021. I'll see you in about 20 minutes.
Thank you. Thank you. What an intro. Yes, I was a red coat at Butlins for Easter 1986 or something like that. It was when the sun came out and they didn't have any lifeguards. So a friend of mine and we went and got a job as lifeguards and we became honorary temporary redcoats. I saved 3 people from drowning, all of them female and none of them who needed it. But there you go. So today we're going to give you an overview of the Lendinvest buy-to-let proposition. There's been an awful lot going on this year already. It feels like we should be further into the year than we are. But this will kind of give you a bit of an overview of where we've been, what we've learnt. I'm going to go back to basics for those that are coming across us for the first time. So moving forward, who are Lendinvest? So we were established in 2008. Around the credit crunch time, the 2 directors or 2 owners of the company saw there to be some potential for a bridging lender to come forward in that time. So there's actually 3 of them with 1 phone in a dark office in London, no windows. Took them a long time to get going. I think it took them 3 years to lend their first 50 million. Overall, though, it was a business that started to grow. This was coming up to the time when peer-to-peer lending was being talked about. It was often a consideration to go down that route, but the business didn't in the end. Montello was the original company name. It was changed to Lendinvest shortly after to kind of give more of a nod to the fact that, yes, we would lend money, but we would seek investment as well. So we set up an investment fund. It wasn't peer-to-peer. People invested in Lendinvest, and as such, they would get a decent return, very decent return on their investment in the business. So as it stands now, we are 75% privately owned by our 2 directors, Christian and Ian. As the years went by, in 2015, we introduced development finance. So we went from providing bridging solutions to going sort of back in the process to providing development funding. We got the ex-head of development at Royal Bank of Scotland, Steve Larkins, come and join us. And then as the years went by, 2017, I joined the business very much purely intent on bringing to market this term loan proposition. It will we'll hold our hands up. Lendinvest aspire to be the Amazon of the finance industry. Quite a bold statement, and as such, in those early minutes of thinking about that proposition, it's like, crikey, how on earth are you going to do that? Well, the message really is that we want to continue to use technology to speed up the process, simplify the process, so that, like Amazon, when Amazon get to Christmas and they get inundated with orders and you've got Amazon Prime and you're entitled to next day delivery, you still get next day delivery. So we hear a lot about lenders getting snowed under the volume of business at the moment. We don't want volume to let down our service levels. So here we are now as a lender, focusing very much on these property types. So very much a quick slide back to basics. Top left hand corner, we lend on residential investment properties, your conventional properties that are let to families, let to single occupants, and then moving across to the top right there, flats above commercial. Flats above commercial is quite a big sector for us. No issue, as long as the flat has separate access, has its own title. We currently do not offer semi-commercial facilities. That's something I very much want to be able to offer in the future, but for now, it's off the table. Bottom right there, that's the best picture I could get of what I believe to be an HMO. That looks to be a small HMO, 6 bedrooms, bit of parking out front, some bins to the sides, bin store. Standard HMOs. We'll come on to that a little bit more in future slides. In the middle at the bottom there, we have what we refer to as multi-unit freehold blocks. That is one freehold title. So that building there is one freehold building with multiple flats in it, all on their own, not on their own long leasehold charge. So up to 10 units with us, 10 flats in a block, 10 units in a block. That's a multi-unit freehold block for us. And of course, on the left there, you can see the conventional flats, the type of thing that you see around most cities. That's the, again, perfect property for us to lend on. So just to recap, standard buy-to-lets, small HMOs for us, up to 6 rooms. We'll value those on a bricks and mortar open market value basis. But when we get to large HMOs from 7 to 15 rooms, for the more professional landlord, potentially operating larger HMOs, sui generis purpose-built properties, those we would value using both an investment, so based on the income and the property. Some people call those long-form valuations, commercial valuations, red book valuations, investment valuations. Basically, it's taken into consideration the volume of income from the business and the property itself. First-time landlords for us is a sector that we've recently moved up to 75% loan to value on. We'd been very cautious over this last year. We're going to talk about the last year in a minute. But yeah, absolutely happy to support first-time landlords now, as we believe we're coming out of this lockdown, this pandemic. From a let to buy perspective, it's something we aspire to do, but we don't actually offer it at the moment. But what we do is we do allow borrowers who are, let's say, they've got a new relationship, a man and a lady who have separate properties. They're coming together. They're going to buy their own. So if they're going to sell their ex-residential property to their newly incorporated SPV, specially set up to look after investment properties, it's a version of let to buy. As long as they're moving into a property with a mortgage and we can understand the transaction, then that is permissible for us to get involved. And not many lenders do that. We've got tier 2 products available now. We're starting to see some landlords having been impacted by COVID, by pandemic, by lockdown, by furlough, by tenants not being able to pay, tenants being made redundant, etc., etc. So we're starting to see some tier 2 applications coming in for people who have had some form of credit blip in the past. Happy to lend in England, Scotland, Wales, not in Ireland. Not really keen on the Isle of Wight either, really. No debentures. So that's something that we've had in England for a long time. All our limited company borrowing, England and Wales, we've not asked for debentures for a long time. And we recently introduced that rule into Scotland as well. So nobody likes a fixed and floating charge over their limited company when they have extra activities and extra borrowing requirements. And the final thing on this slide is a really important thing. We've been offering to cover the cost of title indemnity insurance on remortgages for quite a while now. It's all about speeding up the process. You're going to get that theme through this presentation. But we've recently recognised that searches, land registry, all sorts of things are happening far, far slower than is required for completions to take place. So as long as it's not a new build property, as long as there's been a mortgage on the property before, then we're offering title insurance on purchases as well now. Now, this is a slide. I love this slide because one of the things I do as a lender and as someone within the industry for a long time is I really don't mind talking about our peers and the positives that exist. We all have our place in the market. Now, this slide is getting bigger and bigger and bigger as we see more and more lenders come to market. Some of them are here for the short term, habito. They're not going to be in the buy-to-let market for long, trust me. Some of them have taken some time to learn the ropes and get some funding in place and prove themselves, and they're now starting to come to the fore, like Lendco. You got Molo, who's a disruptor. You got the State Bank of India, who price really low but don't tend to approve anything, tongue in cheek. And then you got your normal favourites, your Lambays, Keystones, Precise, Zephyrs, Vidas, Paragons. You know, we're never going to be as cheap as a Paragon. We're going to have better service than some of these people that are cheaper than us, Precise and Paragon, for argument's sake. But we never aspire to be as cheap as them when it comes to providing solutions, because we're not bank funded. We're funded by investment, which we'll come on to again in a second. We're not funded by banks. We have a higher cost of borrowing, which means we make less profit, which means we have to lend more, which means we have to be very proactive in the industry. But the biggest thing about this slide is remember those names. And if ever you're thinking about dealing with one of those lenders, stop and run your deal past Lendinvest first. Have a look at the calculators, have a look at the product guides, because the volume of business we're doing something very, very right at the moment. So bear that in mind. So what about last year? I mean, crikey, what a year we've had. I mean, I've missed out on so many holidays. The two things I could do with at the moment are a tan and a haircut. I've never admitted, and I'm going to admit now, this is hairspray to try and keep this in place. It is most embarrassing. The buy-to-let proposition is flying. As I said, we've survived lockdown, and we're not in the office. You know, Tony alluded to it earlier. We had a little bit of a downtime where we didn't stop lending. We didn't really reduce loan to values at all. But we kept offering mortgages through the lockdown one. It's just that we weren't able to secure valuations. And off the back of that, we managed to get secured a desktop valuation product for buy-to-let, which was we were the first non-bank lender to do that. Now, going back to the office, we're not there. We're still not there. I haven't been there since last January. We've got people all around the world now. We've got people in Australia. We've got someone working in Australia. We've got a couple of people in Spain, Portugal. We've got someone in South Africa. We've got a couple of people in Norway. We've even got someone in Scotland. It's quite incredible that the technology that's out there allows us to operate a business as normal, not impacting service levels or anything to do with completions. Everyone's available, yet we're all working from home. My car's never done so few miles. So all of that is resulting in record numbers of applications. I posted on LinkedIn on Monday, I think it was, it's been a long week, that last week was our record week for applications received, offers issued, and completions. We are firing on all cylinders. So working from home has taught us that we are able to keep going. We're able to keep providing the service that we want to provide. It's actually allowed us to make some improvements to our proposition that we kind of discovered during this lockdown that perhaps we wouldn't have discovered or worked on earlier had we not been through this. And it's been really important that we keep a close eye on the market. We've taken a very steady approach to bringing out new products, new loan to values, new maximum loan sizes. Never before has it been more important to understand the economy, the market, landlords' habits, and make sure that we're talking to you in the right way as well. We've not got BDMs that are coming around the country visiting. And that actually means we can do more work in a day. There's more visits, virtual visits that can happen in a day. I think there's a lot to learn from this lockdown. And one of the things we established was a broker kickoff day, which enabled us to kind of open the doors of Lendinvest, and I'll come on to that in a second. And the feedback that we've got generally helps us understand how strong our brand is as a proposition and as a lender, and how we're being perceived in the market. When you work for a company, it's often quite hard to understand quite how well you're doing. The stats are great, the figures are great, we aspire to achieve big numbers, but actually it's what people think of you. And the feedback we've received from the customer feedback, broker feedback, landlord feedback, it's absolutely fantastic. So yes, we've accelerated our tech roadmap. There's an awful lot of stuff coming, and I'll refer to some of it in a minute. So in terms of our processing times, very quickly on this slide, we've been let down by the valuers. Valuers are, in some parts of the country, super snowed, literally recently, not being able to go and do visits to properties. Some of those visits haven't happened because people have been shielding in the property that the landlord wants remortgaged, valued for a remortgage. Sometimes we've had valuers off sick as well, but things are starting to change. So we're now finding that the valuers are, in some areas of the country, are asking for work. They're actually looking for valuation instructions as quickly as possible, as they're starting to find that the industry is slowing down. What also is happening is we're seeing some evaluations coming back within a couple of days, which is where we were back in January last year. Excuse me. We've always prided ourselves on our aspirational SLA of application received to formal offer in 14 days. Now, we were hitting that 65% of the time back in January 2020. We aim to be a 30-day remortgage lender. Application in, formal offer out, into legals, 30-day remortgage. We'll be back to that point soon when the valuers start to be able to get back to their SLAs of the past. So where are we now? Well, top there, stamp duty. Yeah, we all know about stamp duty. You'd have to have been on Mars not to know about the stamp duty issue. But that top right-hand headline, buy-to-let investors rush to complete before stamp duty rise. That's actually from 2016. I managed to go back and find that headline. Good old Google. Managed to find the headline that was March 2016. That was when the 3% stamp duty first came in. So not only are we busy with the purchase business for people to save on the stamp duty holiday, stamp duty saving now, we're also inundated with 5-year fixed rate products with their ERCs coming to an end. So we are double busy, if that's even a phrase, on actually being totally focused on many February and March completions. I won't go into details about how much we complete each month, but there's about, honestly, I think now, off the top of my head, we've got about 6 times as much to complete in February and March than we would normally have. It's quite incredible. Bottom left-hand corner, we've made quite a big thing of this in the press, and it was good that the press also picked it up as well, that JP Morgan invested £500 million. They've provided £500 million worth of funding for Lendinvest. There's a lot of money in America at the moment coming across to the UK. I could do a whole new session on money markets and what's going on with investment into the UK. But that £500 million tranche allows us to jettison into 2021 in quite a significant way. So JP Morgan, that's 1/3 of our funding line now. We're equally funded by Citibank and National Australia Bank, with a special line to HSBC as well, if we need it. So there's quite, when you consider that's £1.5 billion that's at our fingertips, that gives you an idea of how busy we are and how big we've grown. Bottom right-hand corner there, watch out for these invites moving forward. Lendinvest opened the doors of the business a couple of weeks ago with a 2021 broker kickoff. We invited people in to listen to presentations, watch presentations, ask questions about various parts of our business, our process, etc., etc. So I'm going to do this slide backwards. Improvement in tech. Yes, we're going to be offering credit-backed decision in principle soon. I appreciate that might be catching up with some lenders. But don't forget, we've only been established for 3 years last December. So not even, well, 3 years and 2 months. So we're doing pretty well considering our newness to the market. So with Jumio, that replaces on Fido. So this means that we do not need passport, proof of address for ID. We send a link to the client asking them to take a photo of their passport and a selfie. The biometrics in the software analyzes the passport and the selfie, does the face recognition, and that does our tech. Jumio is far more secure, accurate than on Fido, so we've just moved across to that. Criteria is improving. We're widening our criteria all the time. There's no point being the cheapest in the market and having tight criteria. We aspire to have the criteria that attracts you. There's too much detail to go through in this presentation, but Tony and his team are fully armed as they deal with us so much with all the nuances of our criteria that enables us to accept many applications. You'll see next month that we'll move away from LIBOR to the Bank of England base rate. That will allow us to provide some extra products, some non-ERC tracker products potentially. So watch this space. And Tony's going to hate me because he's just sent out a lovely brochure to you all, telling you all about our proposition that we updated on February the 8th. And lo and behold, this morning I've launched 3 new special edition 5-year fixed rate products. 3.29, 3.89, 3.4, 3.29, 3.39, 3.49 5-year fixed rate 75% loan to value products. Special editions out today in sourcing systems. Get over to our website and you'll see what they are all about. So our standard proposition, we're up to 80% loan to value when it comes to standard properties, standard houses, standard flats, as long as it's not HMO, MUFB. 5-year fixed rates, 3.89. Fee can be added above the loan to value. Like I said, first time landlords, and then rate drops for all loan to values on the tier 2 proposition as well. That tier 2 proposition allows for people who have had a bit of an issue with their credit in the past. When you think of the foundation F3, when you think of V to 4, that's kind of around about the same lending criteria. So the Lendinvest tier 2 is priced quite competitively, not as competitive as the precise tier 2 proposition, but the precise tier 2 proposition is actually a bit tighter than ours. Small HMOs, we've now introduced 80% loan to value. I might be wrong, I hope I'm not wrong, but I do believe we're the only specialist lender out there offering 80% loan to value on small HMOs. I've just dropped all the interest rates on the HMOs as well and increased the maximum loan limit to £1 million. Large HMOs, we've gone from 9 rooms where we were during the pandemic. We've now coming out of that, so we're up to 15 room HMOs. Again, 75% loan to value is there now, that was 70, and the maximum loan sizes have increased as well. Multi-unit freehold blocks, dropped all the rates on those February the 8th and bought out some new maximum loan sizes, and we're up to 75% loan to value on 10 unit MUFBs. Some little highlights of our criteria. We've avoided lending on basements in the past. We've moved into basements. We've not literally moved into basements. We are now lending on basements in London and Edinburgh. Those tend to be the kind of most popular areas for basements. 70% loan to value, and they must have natural light coming into them. Limited company borrowing, people are borrowing, borrowing, lending, living longer now. Previously, the maximum age at the end of the loan for us was 85 years. We've increased that to 95 years. And if there's some succession planning in place, we take that into consideration as well. We no longer need oodles of experience when it comes to somebody taking on their first small HMO. That was always a criticism of our proposition. We listen to broker feedback. So now if you've had an HMO for a buy-to-let for 12 months, you can now come to us for your first HMO. Maximum 25 properties with Lendinvest, multiple properties you can have in your portfolio elsewhere. We're very much signalling our intent to work with the portfolio landlord. So being able to lend up to £5 million to one client, take 25 properties from that client, is going to promote quite a good relationship between Lendinvest and landlords who are looking to grow their portfolios. We've simplified our gifted deposit rules. It's okay now for us to accept gifted deposits. We had a period of time where we were asking people to put 10% in. We only now require somebody who's receiving a gift, a property, like an intercompany sale. If that property is coming across in its entirety, we ask the recipient to put in 10% of their own cash. And then, of course, I've mentioned title insurance on purchases as well. We previously offered £500 cashback towards legal costs for a couple of our 5-year fixed rate products. They're identified in the product guide, rates guide that Tony sent across with the little coin sign beside them there. So those 65, 70 and 75% products now attract cash back to the tune of 0.25% of the advance, up to a maximum £1,000. So that's a loan of £400,000. So £400,000 loan with us, the client will get £1,000 cash back to go towards their legal costs. And when you consider the starting cost before VAT and the other thing, can't remember what it is, on our dual representation proposition for legals, that is 850 quid. That, fingers crossed, is a bonus for people borrowing those larger amounts with us. A £300,000 loan is going to get 750 quid. It's quite a nice cashback to receive. And actually, if you asked me, imagine you were asking me what is our best-selling product, it's that one there, 75%, 3.59, with a 1.5% fee and that cashback. That is our best-selling product when it comes to our buy-to-let proposition. It's stressed at 5%. So we've been pretty aggressive. We've been even more aggressive today with these special editions that have been launched. You'll see those all over LinkedIn and Twitter and available on our intermediaries website. And we will continue to evolve our proposition as we grow the business. So just to reiterate, in that update that we brought out on February the 8th, we had a new product that came out then, which was especially for corporate borrowers. So corporate borrowers, people who have special purpose vehicles, they are able to use our 3.69 pay rate deal. So there you have maximum £1 million advance, 75% loan to value, not available to individuals. Individuals can have the same interest rate, but they are stressed at 4%. It's all about leverage, as I say there. So from that point of view, it just leaves me to thank everybody for their votes over the last couple of years. This is normally where I'm asking for votes as we do these presentations towards the end of the year. But for a new start lender that came to lending at the end of 2017, after the first full year of trading, to win the NACFB Buy-to-Let Lender of the Year, and then win it again last year, was a tremendous accolade, because that is voted for by brokers and it's not purchased by marketing spend, which I know Tony will share similar thoughts on. So that's it from me.
Andy, thank you very much indeed. Hopefully you can hear me.
Yes.
Can you hear me? Yeah, okay, fine. Okay, yeah, brilliant, Andy. Thank you. Looks like I've got some work to do this afternoon. Thank you for changing all these things this morning. That's marvellous. Got a couple of questions. Michael Bills asked for portfolio landlords under your criteria. It seems that you want to see all the ASTs. Is that correct?
No, definitely not. I don't recall us ever asking for ASTs. If that's something that has been experienced, I'll be absolutely shocked. So no, we don't ask for ASTs for all of the properties in the portfolio.
And certainly, if you use us as your packager, that would never be asked for either, because if it was asked for, we go back and question it, because we know also that it's not something that's normally required. Paula Kalis has asked, do you need to be an NACFB member to access Lendinvest?
The cartel. Oh, I didn't mean to say that. Sorry. No, you do not have to be a member of the NACFB to access Lendinvest. But the best advice I could give anybody dealing with us for the first time is to contact Tony and his team. Dealing with a new lender for the first time is often tricky. Getting to understand the nuances and the process. Tony and his team have got it nailed, having dealt with us constantly for the last 3 years. So I thoroughly recommend that anybody looking to access us does so via Specialist Hub.
Very kind of it. Michael was typing something again. I'll ask one more question that we had previously, because we always come up with a few questions just in case we're not asked any. So, Andy, what are your thoughts on the size of the market post March?
Yeah, that's a cliff edge question, isn't it? Is it going to be a cliff edge? Is it not? Do you know? It's no great secret that we've obviously launched our special editions today to try and snare some market share for post March. You know, as a lender, we have reached such a high volume of applications. We want to stay there. So, from our point of view, we're going to keep offering what we can to entice people to borrow, and I think there'll be a lot of activity with landlords who have been kind of gathering a bit of a war chest over this last few months or year. People who have not decided to potentially buy a property to think that they're saving the money on the stamp duty, but actually the price of the property's been inflated because people think there's going to be a saving on the stamp duty. I think there's going to be some activity from portfolio landlords post-March snapping up some quality property. We don't know what's going to happen. We're determined not to talk the industry down, and fingers crossed that means that we'll have the post-March there'll be a minimal impact on us all.
Okay. All right. We'll just fit in Michael's question before we switch on to next speaker. One of the problems I have encountered is that all lenders are happy to use the pay rate for calculating the maximum borrowing if a client's taking a 5-year fixed rate. However, if they have too many of these, it causes the portfolio overall stress rate to fail. How can you cope with this?
Michael, you couldn't have asked a better question. One of the things that stand out about Lendinvest is that we are a non-bank lender. We are not funded by a bank, and B, we are not a member of the PRA, the Prudential Regulatory Authority. There are a couple of us around, and it allows us to have some degree of poetic license when it comes to our interpretation of background portfolios. We will carry out the portfolio stress test, 125 at 5.5%, and if it comes out below that level, we've actually published in the criteria that Tony sent out to you today how we will then analyse the portfolio to continue to lend. So, in layman's terms, if a portfolio fails the stress test, we will lift the bonnet up. We'll have a little bit of a look around at the whole business that we're presented with, and then we'll make a decision. The lowest we have actually agreed on a portfolio stress test is 106%.
That was us.
So I hope that, Michael, you've kind of got some comfort that as Lendinvest operates, we're very much here to try to lend, not to use a tick box to say no, that doesn't work, we're not interested.
And the advantage of everyone to come through a packager like ourselves is quite simply that that's the sort of thing that we will look at. Is that the vanilla cases, the ones that just sell through, I don't ever get involved in, but the ones where I can see that there should be lending taking place, but for whatever reason it's not passing a particular thing, that's where I get involved and use my experience, my contacts within lenders, just to get those deals pushed through. And that particular deal that Andy mentioned, the 106% one, wasn't an easy one, but it made a lot of sense. Had a lot of sense. Just to add one more thing before Andy goes, a great example of how good Lendinvest are with their system. In December, we completed a case that came in, I believe it was on the 3rd of December, if I can get my dates right, and it completed on the 29th of December. So that's 26 days. That's not working days. That's 26 days in December, the worst month of the year, to try and get stuff done. And it was through in 26 days from start to finish. That's how good this lender is. And that's certainly not the sort of service you see from other lenders in December. Normally because they're all down the pub. But anyway, that's obviously that didn't happen this last December. But that is how good they are. Andy, we're going to have to say goodbye because I need to switch on to the next one because we're running slightly behind time. So thank you very much as always. Great supporter of our shows for many years. And we'll now move over to Marie Grundy. I almost called her Marie Kennedy there, which is her maiden name because I've known her that long. Bear me 1 second. So here we are. Marie is now joining us. So our second speaker is Marie Grundy, West One. She is the Managing Director of Second Charge Loans at West One. So she's certainly someone good to know. And I mentioned I've known Marie for a long, long time. Just checking the hairstyle out, Marie. You're looking okay. You're pretty good.
All right.
Can you hear us fine? Okay, so we'll go as quick as we can because we are a bit behind time now. So you should all receive this via email this morning from myself. It's their second charge product range that's gone out to you. And just a little bit on Marie. She joined West One Sales Director in 2017. She oversees pretty much everything on the second charge side. She's been within the mortgage market 25 years, starting off with the Yorkshire Building Society. And she was also previously, prior to West One, she was managing director of a broker, one of my competitors actually, V Loans, which has given her, she says, a unique insight into the market from both a broker and lending perspective. She's held senior positions within the specialist lending market over the last 17 years, including a board position with the Association of Mortgage Intermediaries. And I voted for you, Marie, all those years ago when you were actually, when you got that position, and was recently appointed onto the board of the newly relaunched Society of Mortgage Professionals. Now, Marie's interesting fact is she normally has two, but I'm not allowed to mention the second one anymore. She once appeared in a Brian Adams video. I did Google it, Marie Grundy, Brian Adams video, but nothing came up. So, but I haven't got time to mention your love of WWE and knocking small children over to get to the wrestlers to hit them with your handbag. So, Marie, without further ado, it's over to you. You have control. I'll see you in about 20 minutes.
Thank you. Morning, everybody. Very warm welcome, and thank you, Tony, for having us today to talk to your broker partners about second charges. So that's what I'm here to really give you a bit more information about what we do and what the opportunities are in the market for second charges right now. So just to give you a little bit of background on West One, for those of you that have not come across us before, we are a provider of specialist mortgages and property finance, part of the Emra group of companies. We currently have about £1 billion worth of assets under management, and our product range spans across bridging and development finance, which is really sort of the heritage of the business. And we've recently also launched into buy-to-let mortgages. So again, you may well have come across West One, not just from a bridging or second charge perspective, but also now for buy-to-let mortgages. Like Andy was mentioning, we're also a non-bank lender. And one of the things I'm really proud of is that we've continued to actively lend and support the market throughout the pandemic. So we were able to manage liquidity and funding and make sure that we were sort of ever present at a time when it was obviously the most challenging for many brokers and customers out there. And the main thing to mention is that all of our products can be accessed via specialist financial services. So we have different distribution channels for our lending products. So for example, with second charges, they are distributed exclusively through master broker partners. Specialist financial services have worked from us pretty much from the launch of our business in 2017. So they know our criteria extremely well, so they're the perfect partner for any second charge inquiries that you might have. Really, what I want to do is just sort of have a little think really about what the impact of the pandemic has had on the mortgage market. So maybe some of the issues that your experiences of brokers in terms of placing business. But I think, you know, something that's really clear is that your role as advisor is probably more important now than it's ever been, because borrowers are going to really rely on the intervention of expert advice and professional mortgage advisors to kind of navigate their way through some of the more complex areas of criteria that might be affecting them as a result, particularly of the pandemic. I think we've all seen throughout the pandemic that most lenders at some point have made adjustments to credit risk. I know we did, certainly straight after the pandemic. We put in place some much tighter criteria to make sure that we weren't going to cause any customer detriment as a result of what was going on out there. And then gradually we've been able to relax that criteria and make it proportionate to the current trading conditions that we're all in. It's really critical also for advisors to make sure that you are reviewing client circumstances and to make sure they're put in the best possible financial position. So, I mean, second charges are always associated with debt consolidation loans, for example, and the demand for that type of borrowing has remained strong because there's lots of borrowers out there trying to maximise household income. So that again may be something that you're seeing demand for from your own clients in terms of them wanting to reduce their outgoings where they can. Another feature, I think, of the last sort of 12 months has been service levels, which I'm sure you've all experienced firsthand, that have deteriorated quite significantly across the first charge market particularly. It also hit some areas of the second charge market, you know, as you know, demand for higher LTV mortgages really hit home during the stamp duty holiday. That's something that we've seen has been an issue for you guys, which I know is getting better now, but it's still prevalent. And the other thing, which is quite recent as well, is we're starting to see much more restricted criteria for self-employed borrowers. So I noticed Santander have restricted their LTV, for example, to 60% for self-employed borrowers. So I think they're an area of the market and an area of borrowers that are obviously going to find it more difficult to access mortgage finance at the moment. So just some areas for consideration in terms of what we're seeing. If you bear with me, I will get to the next slide. There we go. So why are second charges going to be so relevant to you as advisors? So one of the initiatives we've introduced towards the end of 2020 was we brought out some criteria to support bank of mum and dad transactions. So this is an area where we're seeing much more intervention from parents and grandparents to try and support first time buyers or potentially home movers move through the property ladder. So we've introduced some criteria specifically for that to allow you to use second charges to raise deposits for family members. So that's been an initiative that's been really welcomed throughout the market. We're actually just doing some work with Mortgage Introducer to write an article on that topic, because it is so relevant, I think, to you guys as advisors right now. And it's probably a loan purpose that you wouldn't have considered a second charge could be used for before. So we're always trying to find ways to make second charges more relevant to you, but also to sort of the current market as well. We're also seeing much greater demand for second charges to be used to support property purchases in general. So whether that's raising a deposit for a buy-to-let landlord towards a further property purchase, or actually raising the money outright That also extends to second homes. So we're seeing, some quite wealthy clients with high valued properties raising money to purchase second homes either in the UK or abroad. So that again is something that is really getting more and more popular as a second charge loan purpose. Second charges has always been very popular for home improvements, whether they are big or small projects. And one of the reasons that second charges lend themselves really well to that type of borrowing is because there's a lot of flexibility around loan sizes. So, for example, at West One, we can go up to £500,000, up to 65% loan to value. So we are seeing, again, probably not what you would associate as a typical second charge borrower, but again, borrowers who are extremely creditworthy with significant income streams that have properties worth, over £1 million plus, that want to do some big renovations to the property. And a second charge obviously is a really good solution sometimes for those type of borrowers, because we can lend them more money than they would probably be able to raise via a capital raising remortgage or further advance, but B, we can probably get the loan completed in a much quicker time than if you went through those channels, because of the post-conveyancing requirements that you have with remortgages, for example, that don't exist in the second charge world. We are also one of the few lenders that offer buy-to-let second charges. So you can raise up to 250,000 on a buy-to-let property. You can take up to 3 loans per borrower on a buy-to-let second charge. And that, I would say, since the start of 2021, has again really sort of thrived. We've seen even more demand than normal for buy-to-let second charges. So it's an area of the market that's quite underserved. We do have market leading rates in that area. So that's something to consider if you're looking to maximise equity. They might want to refurbish an existing rental property to increase rental yield or increase property value, or, like we've just mentioned earlier, extend their property portfolio, or even borrow for personal use. So it's quite a flexible product that's available through West One. I think we've all seen as well that the mortgage market structure is changing. So we're seeing 5-year fixed rates becoming more popular than they've ever been. And whereas previously 2-year fixed rates were always the product of choice, we're now seeing 5-year fixed rates being taken up on a more frequent basis. And that generally means borrowers are locked into mortgages for longer. It means that they've got early repayment charges that would be applicable if they look to capital raise and remortgage. So again, that's where a second charge might come into its own for that interim period where they're looking to raise some further funds, and it means that they don't incur early repayment charges to do that. And then the other thing we've seen, which I'm sure you're all aware of, is the increasing popularity of the product transfer market. The data that we've got for Q4 2019 saw 44.3 billion of product transfers, and almost half of those were completed on an execution-only basis. So that means that as advisors, quite often, you're not involved in that transaction. So having different scope of service within your advice services that you offer, including second charges, would allow you to go back and speak to clients and make sure that even though they've sorted out their product and they've moved on to a better rate, that if they've got other borrowing needs, a second charge again is an ideal way for you to have a further conversation with the client, explain that you offer that service, and then hopefully if they do have any further borrowing needs, that's something that you can address with them and protect your client bank, because we all know banks are getting more and more aggressive in terms of trying to get to the customer before you do when it comes to the expiry of their mortgage product. In terms of second charges, so the reason why it would really add value to your business is that, just as we've talked about before, it allows you to extend your scope of service so you can look to retain your client bank. They are, your the assets of your business. So you need to make sure that, if you're not in regular contact with those clients, you are at risk of losing them either directly to mortgage providers themselves or to other brokers potentially that offer a wider range of products. So it is really important to try and think about how you can weave second charges into your advice services. It also gives you the potential of better customer outcomes, because just by looking at a restricted number of products and always trying to address further borrowing needs by more traditional routes of remortgaging and further advances doesn't necessarily mean it's the best customer outcome. And I'll come on to some examples of that in a minute. You don't have to be an expert in second charges. You don't have to know the market inside out, because that's what Tony and his team are there to do. So with specialist financial services, they'll research the market and they'll identify what is the best product for that particular borrower and liaise with you throughout the process. Like Tony mentioned, we've known each other for years. Tony has been working within the second charge industry for longer than I care to remember, so they do know the market extremely well and the lenders that they use. So it's really important that you take advantage of that, I believe. The other point to mention is, if you're describing yourself as an independent broker, then you must consider second charges alongside remortgage products. So you have to advise on second charges as well as remortgage products. So that's just, again, something to bear in mind. In terms of the second charge opportunities, so some of the main common reasons that we see second charges being important to borrowers is, the main one being really is it allows additional borrowing without disturbing first charge mortgage terms. So if you've got a borrower who's got a great rate of interest, or maybe is an interest-only borrower, and by taking out further borrowing, that might actually jeopardise their ability to continue having an interest-only mortgage, and I'll come on to a case study in a moment to demonstrate that. Or it might be they've had a change of circumstances, say took out the initial mortgage. So if their credit history is deteriorated, and it means that by remortgaging, they're going to have to sacrifice a high street rate to take out additional borrowing. These are all reasons why second charge might provide a better customer outcome. I talked earlier about flexibility of second charges. So there's flexibility not just in loan purpose, which is virtually any legal purpose can be considered. So aside from the more traditional debt consolidation, home improvement loans, we've talked about property purchases, we've talked about bank of mum and dad transactions. We're seeing quite a lot of applications for tax bills at the moment, as an example. So there's lots of different purposes that can be used for a second charge. In terms of loan terms as well, the loan term can vary. It doesn't have to be exactly the same loan term as is remaining on the existing mortgage. So you can take a loan term generally from 3 to 30 years on a second charge basis. And that term can extend beyond the life of the first charge mortgage. So if you've got somebody, for example, that's got 15 years remaining on the first charge mortgage, but they want to take it over 25 years on a second charge just to keep the payments a little bit lower, that's entirely possible. Speed of completion, that's really critical. We're all more aware of that than ever with the stamp duty deadline, assuming that the Chancellor doesn't extend that. So again, with second charges, one of the fundamental differences is that there are generally no post-conveyancing requirements. So, I can speak from experience in terms of borrowers that, you might be able to get a mortgage offer very quickly. In 7 to 10 days, the lender can turn it around, do their job, get the offer out to you. But then it takes another 6 weeks for the loan to complete, because they're using a panel solicitor, or, at the minute, obviously, solicitors are inundated with work. So that is one area where, to beat that stamp duty deadline, a property purchase transaction via a second charge could be a really good solution. And there's still time for you to do that with us. There's also areas of niche lending. So, for example, if you have a borrower where the property was bought in one name and they've since got married or moved in with a partner, we do allow cohabitees or non-owning spouses to be added to the second charge application, which gives you flexibility in terms of income and affordability assessment. Conversely, if you've got somebody who's bought a property in their own name and since got married and wants to take further borrowing just in their own name, that again is something that we do permit. There's probably about 3 or 4 second charge lenders that allow that, and we're one of them. So again, you've kind of got the best of both worlds there. And then we all know that debt consolidation is, again, like I've mentioned earlier, something that's quite important to borrowers right now. With second charge lenders, generally, if we are consolidating debt, we don't then take that outstanding debt into account as part of the affordability assessment. So quite often, you're able to use second charges for debt consolidation where you might come up against more restrictive criteria in the first charge world. And we've also seen some lenders put greater restrictions in place in terms of how much the customers borrowed over the last sort of 12 months before they'll consider lending to them. So it's less restrictive, I would say, for second charges in that area. And then we have an example here of an interest-only borrower. So I mentioned earlier about interest-only borrowers and how they might benefit from second charges. So I know there are certain lenders out there that if a borrower has an interest-only mortgage and they come to them for further borrowing, no matter how small that loan amount is, it's the only way that they'll grant that further advance is conditional upon them converting all of their borrowing onto a repayment mortgage. So this is an example of that, where you've got an interest-only borrower with a £300,000 mortgage, and they've got a 5-year fixed rate at 1.75%, so a really good rate there. And the current monthly payment is £437.50. And they want to borrow an extra £50,000 for home improvements. This particular lender has said, we'll grant the further advance, but you've got to convert all of your mortgage onto a repayment basis. So that extra £50,000 is going to increase their payment from £437.50 to £1,411 per month. Okay, so that additional 50k is going to cost them an extra £1,000 a month, which doesn't sound like a great deal. So if the borrower was to leave the interest-only mortgage in place, take a second charge out of £50,000 at a representative rate of 4.25% over a 20-year term, that additional £50,000 is going to cost them £300, which is going to save the borrower £663 a month. So there's a massive saving there by taking a second charge out as opposed to a further advance. So that's a really good example of where second charges can work really well. In terms of our own range of products, so we have probably one of the most comprehensive range of second charge products in the market, because we don't just cover residential borrowing, we cover buy-to-let. But within our residential loan range, we cater for quite a wide range of borrower circumstances. So we have a range of variable and fixed rate options with rates starting at 3.99%. We currently go up to 75% loan to value, but that's applicable for employed, self-employed and retired applicants, because we can look at taking loans up to the applicant's 85th birthday. So again, if you've got retired applicants, a second charge might be an alternative to an equity release product. We're also taking up to 100% of regular overtime and commission as well at the moment. So again, that's quite unique. A lot of lenders are taking a much smaller percentage or not taking overtime into account at all. So that gives Tony and the team extra affordability criteria to work with for clients that have continued to earn overtime throughout the pandemic. Affordability is also based on an automated expenditure assessment with us. So basically what that allows Tony and his team to do is get certainty of the case passing affordability at a very early stage in the process. And uniquely, we have products that don't have any LTI restrictions available. So our, if you like, our cheapest range of products has an LTI restriction of 6, but then we have 2 other ranges of products where borrowers can come to us with LTIs above 6 times income. So again, just gives you some extra opportunities for borrowers who are in that situation currently. Like I mentioned, loan sizes again are very generous. We'll go up to £500,000, up to 65% loan to value. We can consider some larger loans on referral as well. So again, we're seeing quite a lot of larger loans coming through at the moment, which is quite interesting. And then the other thing to mention as well is all our cases are looked at on a bespoke basis. So we don't use credit scoring, we use credit assessment. And quite often we'll take cases on a referral where they don't quite fit criteria, but we can look at we've got the opportunity and the time to look at the customer's individual circumstances, and that just means that we can work with brokers to find solutions that are not necessarily published in criteria but make sense for us to do, because we can establish long-term affordability of the loan. So that's always useful to have in your armoury. Coming on to buy-to-let second charges, so I've touched on that earlier. This is a really great product, and it's very popular with landlords. So I know there's quite a lot of buy-to-let mortgages that were taken out on a 5-year fixed rate basis that are coming up for maturity, but for borrowers that are still in 5-year fixed rates, or might be with a lender that, you know, they like Mortgage Express, where they're on a great base rate tracker product, and don't want to disturb that, second charges are a great alternative for landlords and just gives them some flexible options. And like I mentioned earlier, they can use them for a variety of purposes, including personal use. So this is a case study where it's an experienced landlord who'd got a couple of buy-to-let properties already, and he's looking to add to his portfolio and needed 95,000 for an outright property purchase. So he'd got an existing first charge with a high street buy-to-let lender on really great terms, so didn't want to disturb that by remortgaging. All the mortgages within the portfolio had all been conducted really well, and the applicant was able to demonstrate to us it had savings in place to meet any potential rental void periods. So that was, again, a loan that we were able to do on an interest-only basis, because all of our buy-to-let products come with the option of interest-only, which again gives landlords more flexibility in terms of the repayment structure, at a rate of 6.49%. So again, that's a good example of a buy-to-let second charge, and we see those scenarios on a regular basis. So like I mentioned earlier, we're one of the few lenders offering buy-to-let second charges. At the start of the year, we reduced our rates. So we have rates now starting at 5.99%. They are market-leading rates. They cover consumer buy-to-let products as well as unregulated products. Again, we've got a range of 2 and 5 year fixed rate products and variable rate products, all up to 75% loan to value. With all of our products, including the residential range, there's the option to overpay as well. So if it's a fixed rate product, you can pay up to 10% annually. If it's a variable rate product, there's no restrictions on the amount of overpayment, particularly obviously if there's no ERCs involved. We've got loan sizes starting from 10,000 to 250 for our buy-to-let range, and we're also not regulated by the PRA, so we have very straightforward debt service cover calculations, which is 125, 145 or 165% rental cover, depending on the tax banding. And we don't stress properties in the background, so there's no further stressing. So if you've got somebody with quite a large portfolio, again, we might ask for a little bit more information on the portfolio and the properties that are within that, but we don't apply a separate stress test to those properties. We can lend to individual landlords, not corporate limited companies at the moment for our buy-to-let second charge product. We can also look at licensed HMOs on a referral and expats up to 65%. And we can also allow up to 3 loans per borrower up to a maximum gross lending. Actually, now we've just changed that to 750,000. So lots of opportunities for multiple applications from landlords with West One as well. So just to recap, I do feel quite passionate that second charges do really add value to your service. And the only thing I would ask is, you know, don't think of second charges as a product of last resort, that they're only there to support borrowers who've got no other place to go, that, you know, they're the only sort of borrowers that we see are adverse borrowers. It's actually quite the opposite at the moment. About 70% of our business is coming from borrowers with really high credit ratings, that have really good income streams, that are using second charges because it's the right thing for them to do. It can obviously give you greater options in terms of your services that you're offering. So it provides a much more holistic advice service, and you're also actually probably going to see much better customer outcomes by thinking about second charges alongside remortgages. In terms of regulatory perspective, we are on a complete level playing field with first charge mortgages. A mortgage is a mortgage, whether that's the first or a second. We have to play by exactly the same rules, and it's exactly the same consumer protection. So that's one really positive aspect of the second charge market. And just remember, obviously, that speed of completion is something that second charges often can deliver as well. So just a reminder, just to go through Tony and his team, if you've got any second charge inquiries, they know everything about West One and the second charge market.
Marvellous. We are slightly behind schedule. We're actually way behind schedule, Marie. So I'm going to ask one question. There's been as many questions. I'm going to ask one question when I have to take our break. But thank you for that. It was marvellous as always. I think your email was on, by the way, because I kept getting a notification every time you received an email.
Sorry, I had to turn that off.
Yeah. So, but I didn't want to interrupt what you were saying. So, one question I've got is why? This isn't from me, by the way. Why can brokers not submit second charge applications directly to West One?
So basically, we've always set up our sort of operational resource to deal with master brokers that are dealing with second charges on a daily basis. So all applications are submitted to us on a fully packaged basis. So that it's really from a point of view that we're dealing with people that are experts in this field, that know the market inside out. And the reason for that is that the loans actually complete much quicker that way. So it's a much smoother customer journey. And it just allows you to concentrate on your day job and leave it to the experts like Tony and his team to do all that sort of heavy lifting for you. But that's really the only reason. And obviously we want to encourage more brokers to consider second charges, but it just works a lot better that way, I believe.
I agree. But then I would, because I'm one of your brokers. So, okay.
Thank you, guys. Thank you for your time.
Yeah, thank you so much, Marie. Welcome back, everybody. Hopefully you can hear me. As you see, I've lost the headphones because I've got to admit they were driving me mad, and I couldn't actually hear what I was saying myself. So hopefully you can hear me. Somebody's put, Tony, can we check sound? I couldn't hear you just before the break. Okay, there might have been those headphones packed up. Unfortunately, another impulse buy on Amazon. I'd had a couple of glasses of wine, so they'll probably be given to one of my grandchildren. I think it's probably the best bit for those. So continue what we were using previously, which is this thing, another Amazon purchase. So I'm just going to introduce our next speaker, who hasn't appeared as yet, so I'm hoping he's about to. I'm just going to check he's actually in the room. He is. He does appear to be. Okay, so this is the first time Shawbrook are presented at one of our shows. So a big welcome to them. So we have Lee Williams, who's I'm trying to remember what is he? Lee is a regional development manager. Let me get his title right, for Shawbrook Bank. We've never actually met him face to face because he took over during lockdown. So of course we've not been able to see him. We've done a couple of Zoom meetings with him so far. Seems a really good guy. So you should have received this this morning via email. And by the way, there has actually been 3 people who signed up during the break for today. So if you've just joined us, welcome. You've already missed a couple of people. So Lee, you're a bit dark, by the way.
Oh,
I can hear you, but you're quite dark.
It's not my tan, Tony.
Yeah, absolutely. Yeah.
Can you see me right now? Is that better?
Yeah, I can see you fine. It's good to see your hair hasn't been affected by COVID either, so that's marvellous. Okay, so okay, let's get on to, so you should have received that. So a little bit on Lee first of all. He's a regional development manager, Shawbrook Bank, covering East Anglia and Essex. Been with Shawbrook for nearly 3.5 years, and prior to that, he has 30 years experience in financial services, predominantly with high street banks. He told me he was in his early 40s, by the way, when I first met him, so I'm not quite sure where the 33.5 years has come from. Lee looks after 115 brokers in his region, helping with regulated and unregulated bridging, buy-to-let and commercial and semi-commercial investment mortgages. His speciality is working with brokers to shape large loans to present to their complex deal forum for early-stage board approval. Okay, we are behind times, Lee, so I'm not going to sort of stand in the ceremony. I'm going to let you get straight on with it. So onto that one. Oh, sorry, your interesting fact. I do apologise. There's me trying to rush things through. Lee is a keen snooker player. That's obviously down to a misspent youth, and has won a couple of amateur tournaments at local club level and once played against a professional player. Any names, or has it got to remain secret?
Yeah,
did you beat him?
It's probably not a name that anyone would have heard of unless you're from Norfolk, where I am. But it's a guy called Barry Pinches.
I've heard of him, yeah.
got to the quarterfinals of the World Championships one year, and actually I saw him on telly this week in the Welsh Open where he lost 4-1 in the first round. So yeah, he's not a superstar, but
did he beat you? Come on.
He did. Yeah, I went for a risky. I was on a break of 13, went for a risky double, and he cleared up, and that was the end of it. So
there you go. He hammered you. Right. Okay. Lise, over to you.
Thanks.
So we are slightly behind time at the moment. So you haven't got a lot of slides, which is good. So yes, all over to you. So
okay,
I'll see you in 20 minutes.
Yeah, thanks very much. Thanks, Tony, for inviting me to this. It's really good to be involved, and I haven't got a huge amount of slides, so hopefully we will make up a bit of time for you guys. But I'm really pleased to be able to present a bit about the market at the minute, a bit about Shawbrook, and more specifically, I'm concentrating on commercial and semi-commercial investment products today. So looking at where we are at the moment in terms of specialist lending, throughout the lockdown period, Shawbrook remained open for business. In fact, the week before the first lockdown, 99% of the bank went from working in the office to working at home. We were continued to be able to operate without any impact on being able to get money out the door. Whilst valuers weren't going out to visit, we were still able to do desktop valuations where we could, and we still managed to get loans completed during that time. Whilst we did have a few restrictions on loan to value in certain areas during the first lockdown, we were still lending across all sectors, including commercial and semi-commercial investment, where some of our peers were closing their doors and not able to lend. So that's where we've been. Where are we now and what's next? So there's no doubt COVID's going to change the shape of the property market and the way that investors transact going forward. There has been restrictions in lending for investors, but smart investors know that these kind of challenges provide opportunity for them to maximise their profits and their opportunity, really. And there is market liquidity, so different from the 2008 crash. There's plenty of money around in the market. There's plenty of, the issues aren't banks lending. In fact, as Andy said earlier, there's record number of applications coming in at the minute, which is what's causing delays. But then more than ever, there's an opportunity for specialist lenders like us to fill the voids where the high streets perhaps have vacated their appetite. So, in terms of investment, property investment and things like that. And there's lots of opportunity for smart professional investors who are our prime client base. The signs are that the government's supporting the property market, and obviously they put in place the stamp duty holiday, which may or may not come to an end at the end of March, but the feeling is that it might be extended or it might be a tapered finish, so there's not a cliff edge at the end of it. I listened to the parliamentary debate last week, and certainly the feeling was, allowing people to complete deals that are in pipeline and not penalising them through no fault of their own could be the way forward. But we should wait and see what happens on that. The minimum affordability standards that the Bank of England set can and has restricted gearing for landlords. There's no doubt about that. But there's also going to be changes around how firms work, including the use of their commercial assets. So big serviced offices, big offices that businesses have, with most people now changing the way they work, with an element of either continued working from home or a hybrid version where they might work at home for some of the period and not during others, might mean that there's no need for big old office blocks anymore, and they might look at changing those to smaller units, which might create opportunity for those larger assets to be converted into things like resi. Refurbishment and development might be a smarter option for adding value to people's portfolios. So we're seeing a lot of opportunities where people are perhaps buying semi-commercial property, converting it into residential under the new permitted development rules. Developers we're seeing a change where they're looking to hold on now for short to mid-term investments rather than sell if the market isn't right for them. On buy-to-lets, we're seeing people moving away perhaps from ASTs where they've perhaps been hit with some void periods, and looking at 3 or 5 year corporate leases with people like local housing associations or charities where they might be housing some vulnerable tenants. And we can certainly look at those where we've got kind of a reputable agent that's looking after the house and looking after the tenants. And from the landlord's point of view, they've got some guaranteed rent coming in rather than the uncertainty of void periods. So that's been an interesting change. There's no doubt technology is playing a massive impact in developments that we're seeing. We've invested, I think, £4 million this year in our Broker Hub technology, which is about to be launched soon, which will massively speed up the process from an application coming into money going out the door. And we've also looked at AVMs, automated valuations, and we've increased last week our ability to do automated valuations up to 2 million in London and up to 1 million in outside of London on residential properties. But there is also the importance of having a blend of both technology and also the human touch of somebody who's experienced in lending and can look at a deal on its merits and look at it through their eyes rather than a credit scoring system. We don't use credit scoring. It's all done. We do credit searches, but it's mostly down to the underwriter's experience and feel for the deal. So using specialist lending to maximise potential. So first of all, with Shawbrook, we've been around since 2011. We were born out of the last recession, so we didn't have the legacy from the previous crash. We are a traditional bank that takes in deposits and lends, and we've lent in those years £6 billion in lending in commercial property. We've won multiple awards. And so we're well known in the property investment industry as a market leader. The key thing about using a specialist lender really is to maximise the potential. So it's really important that you build up your relationship with your contact with the lender through the regional development managers and underwriters. And we have our underwriters are able to talk to brokers. They're more than happy to, and they're human. And they, as I say, I can present deals to them to see whether we've got appetite to do it, even if it doesn't quite meet our criteria. And more than that, we have a complex deal forum which has members of our board, so group credit, the head of underwriting, head of risk, and at a really early stage we can engage with them to see if the deal's got appetite, got merit, and that we've got appetite for, without having to go through a full application process. We've seen developers now using bridging finance, like developer exits, to maximise their potential for each development. I'm not going to talk too much about bridging finance because that's not really what I'm here to talk about. I've spoken about the longer leases that we can consider. So semi-commercial, commercial landlords may now want to diversify their portfolio with the change of planning laws by using permitted development to convert to resi. So as I say, we can help with that in terms of bridging to enable them to do their works and then switch to a mortgage. And the government's relaxed planning on housing is going to be a help to help meet the bridge between supply and demand. So Shawbrook's proposition. So as I said, we've been around now for this is our 10-year anniversary, so happy birthday to us. The property division is the main part of the business, and we're committed to supporting landlords and SMEs with property transactions. We only work via intermediaries across the UK, such as specialist financial services, and we value the relationship they have with their introducers, with their clients, and their knowledge of the market, not only our products. We've got a specialist expertise, so our underwriters are all really experienced. We have a simple product range, which I shared with Tony, and I think he sent on to you guys earlier. And we have transparent criteria, which is published on our broker hub. All of our brokers can see what our criteria is and how the underwriters underwrite. As I said, it's not just down to the black and white criteria. We can still also consider good deals that don't quite fit within that criteria. And we have a responsive service. So there's lots of lenders, as highlight of the day, or the theme of the day has been really lots of lenders experiencing service issues at the moment. And yes, things are taking longer because of volumes of work that solicitors and valuers have got at the minute. And as I said, we've seen record application numbers as well. But I'm pleased to say that our service levels are around about 3 to 4 days from a full pack coming in to be reviewed, including the valuation, to getting the formal offer out, which is good for us, and will only be improving as we go forward as well. We've won multiple awards for our products and services this year. I think our commercial underwriting team have won Commercial Underwriting Team of the Year, which we're really proud of, and the bridging team as well have won awards this year, I think. So moving on to the subject of the day, commercial investment. So I'd say that in the commercial and semi-commercial investment space, you've got the high street banks that may or may not have appetite for lending in this sector. If they have, they generally want to lend only on the terms of the term of the lease, or perhaps 5-year term, and they probably want capital and interest repayment. They would be much cheaper than us on rate, but it creates uncertainty for the investor, because every 5 years they will then need to reassess appetite, probably pay another arrangement fee and another valuation fee, and they may need to rebank their whole relationship if the bank no longer has appetite for that particular sector. So we would put ourselves probably in the market with the likes of Interbay, Hampshire Trust, Aldermore in terms of commercial and semi-commercial, Aldermore when they were lending. At the moment, especially, it's very few players that are in the commercial investment market, although they are starting to come back now. As I said before, during COVID, we haven't withdrawn from any of the commercial investment space. We still lend in sectors that would be perceived as sensitive, such as retail. But we look at each deal on its merit. We may reduce loan to value to 65% if we think it's a tricky deal, or perhaps not the strongest. But we've got a strong client behind it and a good tenant covenant, then we are lending up to 75% loan to value still. So our rates are a bit more expensive than the high street. So we start on a semi-commercial property at 4.5 plus our 0.75% Shawbrook base rate. So 5.25 is the starting point. But there's some key reasons why people would choose to pay a premium to obtain our terms, really. So on commercial and semi-commercial investment, we can lend up to a 25-year interest-only term. We can lend up to 75% interest only. So 70% generally on commercial investment, 75% if it's a semi-commercial. And as I say, that's interest only. Our minimum loan size is only £50,000, whereas some of those other lenders will have a higher minimum loan size. And we can go up to £25 million as a maximum loan size. So we can offer more certainty to the client that they've got a longer term and they're not going to have to remortgage every few years. We also offer fixed rates for 3, 5 and 10-year terms. So you could have a client who's got a 10-year fixed rate. But the other good thing about our products is that we don't have any long early repayment charge periods. So after the first 5 years, there's no longer any further early repayment charges, and the client could be free to leave. So if somebody's on a 25-year term and they've got a 10-year fixed rate, after 5 years, they could walk away without any break fees. And so that flexibility also wins us a lot of business. The other thing is that if somebody was on such a long fixed rate and a long term, but they decided they needed to leverage some extra cash out of the property, perhaps to look at another opportunity, then we can do a Shawbrook refinance without charging the early repayment charges to enable them to repay the old loan, leverage the extra cash on a new loan, and as I say, no early repayment charges, and then only pay half of the arrangement fee, so 0.75% instead of 1.5%. Some other key reasons why people come to us is that on limited company borrowing, we only take 25% personal guarantees as standard, whereas most other lenders would want 100% personal guarantee, and some may or may not want to take a debenture as well as the guarantee. At Shawbrook, we don't take debentures against the limited company lend, so it really is just a 25% personal guarantee and a charge over the asset, which is very attractive to investors. Our experience criteria on commercial investment, we've seen in recent years a shift from people looking to move from residential investment portfolios across to semi-commercial and commercial investment to diversify their portfolio, help increase sort of their yield in terms of the portfolio stress tests and things like that. So we've relaxed our experience criteria. So for somebody to get their first semi-commercial or commercial investment property, they just need to have 12 months in buy-to-let investment experience as a minimum, with 2 years left on the commercial lease or the commercial term, 2 years left on the lease or 2 years till the next break, or alternatively, just 2 years left until a 2-year sector experience in commercial investment. So it's much easier now to get your foot on the ladder in the commercial investment space with us. We've also got this complex commercial investment product, which is a really interesting product. and nothing really like it in the market as far as I'm aware. It's only a 5-year term on this product, and it's really experienced operator who's got a track record of doing similar projects. But it's for those kind of opportunities that don't really fit anywhere in the market. So things like vacant commercial, serviced offices where they're let on short licenses rather than on fully repairing leases. So we can get the deal in, have a look at it for the first 5 years, and then refinance it on standard commercial investment terms once we're satisfied with how it's running. Also, things like vacant commercial, if they're buying a property, we've seen instances where people are buying commercial industrial sites or commercial buildings and either running down the lease so that they can get permitted development rights to convert to resi, or it might even be vacant already. So it enables them to get the property on it, own it, and then do what they need to do and then switch over. So a really interesting product there, and something that, as I say, we've picked up some interesting deals on that, which wouldn't fit anywhere else really. Just seen a question come up around lending to pensions. We can lend on pensions, but the minimum loan size, because of the complexity of those type of deals, is £1 million. So kind of we don't tend to do many for that reason, because you need a £2 million pension to be able to lend up to that level. So that is that in terms of our products. And then I've just got a quick case study. So this was a case study that came to us from one of our brokers looking to secure funding for a vacant office in Watford, which was owned by a collapsed retailer. I think it was Mothercare off the top of my head, and also a PRS apartment scheme in Kent. So they wanted to borrow £13 million and £9 million respectively. And they came to us late April last year, when many lenders were struggling with the implications of COVID, and some of them are closing their door. So our commercial and bridging teams, along with the broker, worked tirelessly despite these challenges, with us all working from home, and managed to secure the funding that they required. And from first contact, we completed the case, and the funds were released within 2 months. So they were delighted to secure both properties. There's a huge amount of investment potential. On the scheme in Kent, we provided the full £9 million required on a fixed rate 5-year interest only period. And on the vacant office building in Watford, we released £13 million on a 12-month bridging loan. So absolutely brilliant result in a really difficult, challenging period. So any questions, happy to answer them, or contact the team at Specialist Financial Services. I'm more than happy to have any cases run past me initially to see if it fits with our criteria. But yeah, it's been a pleasure to talk to you all, and any questions, please ask.
Lee, thank you very much. There is one being typed. You've already answered one, but there's another one being typed. I was going to ask you, and thank you, by the way, for making the time up. That was brilliant. So Ashley Porter has come through. Do you do bridge to term loans on commercial, i.e. for commercial to residential conversion?
Yeah, we do. So that's a really good question, actually. And we've got a fairly unique proposition on bridge to term. So yes, so if somebody's buying a commercial property and converting it to resi, that would fall under our heavy refurbishment bridging product, because there's a change of use there. So we would do the initial bridge, and the good thing about our bridging is we add the arrangement fee on top of the maximum loan to value. Once they've done the work, the same value will then go out to confirm what the afterworks value is, and then we can switch it to a residential term mortgage, and we'd only charge half the arrangement fee for the term exit. So it's 2 separate applications, but they'd save money on the term costs, term loan arrangement fee, and they'd have the certainty of the same valuer confirming the afterworks value. So there shouldn't be any nasty surprises from a different valuer from a different lender who might have a completely different view on what they've done and wipe out their profit. So yeah, it works really well on those type of examples, and certainly we're starting to see more of those kind of opportunities where people are looking to take advantage of the relaxed permitted development rules.
Okay, one last question, because I think that will just pretty much put us back on time. So, are you seeing a shift from people investing in buy-to-lets, or from buy-to-lets to semi-commercial or commercial property investment?
Yeah, as I said in the presentation, really, we have started to see that, and that's one of the reasons why we relaxed our experience criteria. And it's partly because obviously they don't have to pay stamp duty on commercial property. It's partly because the yields will help with the outside portfolio stress tests. And also, you know, if you've got somebody on a fully repairing lease that's going to maintain the property and return it in the state that they left it, then that's attractive as well. So we definitely did see that before COVID struck. I think people are obviously a bit more cautious now because of, you know, it's turned on its head, really, isn't it? What was a prime commercial property with a blue chip tenant previously, now you'd probably want a convenience store or a takeaway as your tenant, and that would be a prime tenant. So there's definitely been a shift in what's a great tenant and what a good commercial investment property looks like. But as I said, you know, smart property investors recognise that opportunity, and we're definitely seeing an upturn in those kind of applications.
Lee, thank you very, very much indeed. I know the team are actually waiting for you to finish because I think they might have a couple of cases they want to go through with you. So thanks as always. Yeah, absolutely brilliant. If you have anything, I mean, I'll cover a little bit on Shawbrook a little bit later on what we can offer and how we work with them and some others as well. Yeah, I'll let you go, Lee, and
great stuff.
I'll speak to you later.
Speak soon. Thanks, Tony.
Okay. So everyone, we're just going to now just put on the final speaker who is in the room and he's now been added on as a presenter. So I'll do his introduction. So we have, and I've lost my clicker. There it is. So our final speaker before I come out with my bit at the end is Steve Allen from Hope Capital. And you was actually sent 4 items. I didn't want to sort of just basically load a load of slides. So you got the 70s collection, the 80s collection, the 90s collection, and I must admit I can't remember what the other collection was because I was doing it late last night. But it was another collection of some sort. So you got four different things. There is a lot more criteria they have, and I believe Steve's going to be covering some of that within his presentation today. So just on to a little bit about when it comes out about Steve. So before joining Hope Capital, Steve worked as a specialist finance broker and business development manager. This experience and the skill set obtained gives him all the tools required to understand the needs and requirements of the lender, broker and client to ensure excellent service is provided throughout the process. Steve fully understands the market and is able to give information, advice and guidance on exactly how Hope Capital and its bridging products can meet the needs of their clients. And Steve's interesting fact is, and the reason I put the picture up was because this is exactly what I did yesterday when I was looking at this. He has 5 Shiba Inu, I hope that's how you pronounce it, Shiba Inu dogs, and they look like little foxes. When I looked at this on Google yesterday, they look like very big foxes to me, more like a wolf, but lovely looking dogs. He's got 5 of them. I struggle with 1 black Labrador. So, so Steve, are you there? Are you? He's down as a presenter, but he hasn't actually appeared as yet. So. Oh, there he goes. Right, here he is. Can you hear us, Steve?
There we go. I can hear you. Can you hear me?
Yeah, can hear you fine. You okay?
Yeah, very well, thank you. How are you?
Okay, I've done your introduction. As you can see, there's a picture of one of your dogs because that would be stalking. Yeah. That was a Google picture I got yesterday. So on to you, Steve. We're bang on time. So yeah, keep it within time. Otherwise, I've got to do my bit at the end. But over to you.
Do I need to click this screen share? No, you've done it.
What I'll do, you click the screens. I've just put it on your first slide.
Perfect. There we go. So everybody can see. You see that? Okay, brilliant. Good afternoon, everybody. So as Tony's already mentioned, thanks for the introduction. BDM, one of the BDM team at Hope Capital. I've been with Hope nearly 2 years now, and it's all going very well. I think. Bridging in the main is getting busier and busier all the time. We're certainly seeing that. So I'm pleased to obviously be doing this presentation today. Anything obviously at the end put through Tony and the team. Happy to chat with you directly as well if you have any questions or queries. Here we are. So this is the first time I've done this one. So brilliant. So really, I guess just want to quickly touch on bridging. I'm not really sure of the experience levels of everybody here, but from experience of doing roundtables before, some brokers are adept at doing bridging, have done it for a long time, and some may not have done. So in terms of bridging, obviously in terms of why bridging really, it was invented, so to speak, to get things done quickly. That was the whole point of bridging. So certainly whether there's a chain break or someone wanted to buy at auction, that sort of thing, or these days we're finding a lot of people are buying them for investment to, you know, buy up a property that's perhaps not in a fantastic condition and needs a refurb, whether it be light, medium or heavy refurb with extensions, etc., before they then either sell them and make their profit or turn them onto a buy-to-let and add them to portfolio, which is becoming far more common these days. We're finding that a lot of people are shying away from investing in the traditional retirement route of pensions because the returns have not been fantastic over the last so many years, and property has always been very much a go-to investment where you think that essentially it's quite safe on the long term. That's becoming far more popular where people are actually putting their money in retirement. But there are many uses for bridging. So it could be to raise money, to buy a property quicker, as I've already mentioned. It could be for just refinancing to put towards another purchase or another asset that they want to buy quickly and not miss out on. It might be that there's a distressed sale, that sort of thing. So many use it, but we're finding as well that rebridging is becoming quite common at the moment, with difficulties in people obviously all around the COVID-19 delays of having refurbs done within the timescales, builders, etc. Everything's been a lot more difficult, a lot more drawn out. So it's essentially been a go-to product to try and get things done quickly, and they've had to refinance out of existing bridges. So that's something that we do offer as well. We will offer. We can quite happily do a rebridge, and of course it's lending as well to foreign nationals, BVI companies, which I'm doing one at the moment. A little bit more complicated, but really the sort of thing that you wouldn't necessarily find a high street bank being interested in doing. Generally bridging, and especially Hope Capital, very flexible in our approach to lending. So just scrolling through, so why are we different to everyone else? Well, we're quite a small team. I think we're now at 21, so we've grown quite a bit over the last year. But we're essentially a small bridging firm, privately funded. We do have funding lines as well, but we can make very quick decisions as a principal lender. So we're obviously doing the short-term bridging only, when unlike previous presenters such as Shawbrook, who've got the longer-term products as well. So we're very much a pure bridging company. That's what we do, and we do strive to lend on every deal if we possibly can. Not every deal obviously fits criteria or appetite at the time, but generally we try and make a deal work, and we tend to be, not only do we get vanilla deals on our prime product, which I'll run through later, but we do get a lot of tricky deals other lenders are not too keen on doing, that we will lend on. So that can be through to property being very unmortgageable in a poor state, through to offering loans to people who have adverse credit as well, of varying degrees, whether it be very light adverse, a tiny CCJ, right the way through to previous bankruptcies, mortgage arrears, and that sort of thing. So we're very much a non-status lender as well. So we can offer that to your clients to hopefully solve problems. And we have seen more in the adverse side of things recently. I guess that's due to COVID. It's a knock-on effect with some people, which is a real shame. And they're having to, in some cases where they've had arrears on mortgages, sell fairly quickly and obviously not get the full value. So it's best that they actually refinance onto a bridge, give them time to sell and get full market value for their property, and get their debts paid off. So that unfortunately is becoming a little bit more common, and that's something we're happy to look at. So just let the other slide. Sorry, I've got this window keeps opening in the wrong place. So really, we as a principal lender, we're very proud of the fact that we make decisions quickly and we focus on service, and the fact that you can speak to a decision maker. So not only can you speak to me, but if you have a new application, very happy for you to speak directly with underwriting teams, which I know some lenders are not too keen on, but actually we encourage that. And also our managing director and chief executive as well are always available if needed, to be able to speak to them as well. But the point is, we can get quick decisions as a small company, and in bridging, that's absolutely essential. As Tony's mentioned already, my background was a broker, and I was specialising in bridging. And one of the things that surprised me most is with some lenders actually how long a loan takes, even if it's a bridge, which I've already mentioned. It was originally all about speed, especially with auctions, but we genuinely can act quickly. Some with underwriting can be quite lengthy, I found as well. You might as well just do a standard mortgage. Essentially, you're paying more money for a bridge because you want it done quickly, in my opinion. So we are very good at that. That is our key USP, really. And also flexibility as well. So not only flexibility, when things are underwritten, I mean, you'll already know things go a little bit wrong at times, whether it be on the legal side, the valuation, and we do everything we can in order to make that deal work and still get that deal to completion. So we're not ones for sort of changing our minds on things. We do try our very best to get that across the line, which is obviously fair for your client and fair for the broker as well. We don't make money out of turning deals down. We only make money when we complete a loan, as the same as yourselves. So we want to try and make a deal work. So in terms of flexibility as well, we have options on our bridging loans. So we offer not only retained interest option, which I must admit is the way most borrowers prefer to go, but also we can offer fully serviced loans or a mixture of part service, part retained, and that can be spread over the full term of the loan, or the payments can be deferred, almost like a payment holiday. Now that's actually quite important. Two reasons. One, by part servicing or servicing means that they can net more on day one. And secondly, on the servicing side of it, if it's deferred, it might mean that someone's buying a property for turning into a buy-to-let. They want to do a light refurb, so they're spending money, no tenant, no income from it. But during the term of the loan, they will get a tenant into the property once they've finished, and they'd rather start making payments later. So it might be from month 6, whilst they're organising the buy-to-let mortgage to be our exit. So, sorry, this little window is just in the way all the time of my presentation. So we've got an experienced team. Everybody in the company are very experienced in terms of the underwriting team. Everybody has years of experience, the BDM team as well. So you'll have confidence when you pick up the phone that actually the person you're talking to knows what they're doing. In terms of assets we lend on as well, so we lend on residential, commercial and mixed use properties, and also land with planning. So any inquiries on those bases, and I'll run through criteria in a moment. I'm just moving on. There we are. Now, in fact. So our core lending criteria, just a quick run through on that, and then I'll go into specifics. But we've got a discounted product, and it's very, very flexible product, in fact, that starts from 0.54 a month. It's a product that's got a stepped rate. So again, we're very transparent. First 6 months at 0.54, and then there's a second tier as well. So that's obviously more expensive. But what it does, again, is help people net a little bit more money day one. We've got a product called the 70s collection, which I'll refer to in a minute, where we go up to 72.5% at 0.725 a month, and up to 75% as well. And it's one of the cheapest in the market in bridging. Our standard rates from 0.83. I'll run through again that in a moment. No exit fees for our standard bridging or our 70s collection as well, and term from 3 to 18 months. We tend to find that most people go for 12 months, as you'll be fully aware. Do have options to do more if people are doing a heavy refurb, for example, and need more time to refurb and refinance. So that's usually when more work's going on. But generally, the 12-month term can have a shorter term if you've got the exit in place. No problem if you wanted 8, 9, 10 months, whatever it might be. And we will go to 75% genuinely on residential properties. Now, on that note, we work off a 180-day valuation basis. So, and I get the question very often, so that I'd cover that off now. And we use 180-day across all asset classes. Refurbishment as well. We will lend up to 100%. Generally, it is 100% on the refurbishment costs, as long as we don't exceed the GDV that I will come to in a moment. And up to 75% day one. But the refurbishment costs are done in arrears, and the GDV is proper GDV that we work off. had some experience and some questions previously from some of my brokers, and that is that I know some lenders work off a revaluation. So whilst they're doing works, waiting for drawdown, the value will go out and value the property. They down value it because they've taken out the kitchen and the bathroom, etc. And of course, it's not going to have a value, or a lower value at least, and therefore drawdowns are then difficult. But we work off the GDV, not off the value at that time. As long as we've seen receipts, etc., showing that they have spent the money to get to that point, then we work off that original GDV figure. You can use it for capital raising, for any business purpose. It could be for a tax bill. It could be for many uses. So other projects as well, we find people are raising money for, whether it be to buy another property quickly and they need this for their deposit, whilst they then get the other property onto a refinance or buy to let. So it could be properties off plan or distressed sales, etc. I mentioned already about credit status. That's something that we ask for a credit report when we have all applications in. We don't do any credit checking just to answer any questions that might come. We don't want to leave a footprint. That's the reason we ask for you or the client to provide their credit report. And of course, rebridging as well. We're not keen on it being their third or fourth rebridge, but if it's their first rebridge or maybe a second one, if there's a good reason for it, then we're happy to lend on it. And we do not reduce our loan to value percentage just because it's a rebridge. So we'll still lend as per our original criteria. We may load the rate slightly by 0.05 per month, depending on the circumstances, but that's on a case-by-case basis. Mentioned already about servicing, etc., and it just has to be down to whatever suits the client best, really. We're flexible with it and try and make, or give you options to present to your client, so that it might be different driving factors for them, that they want to net more day one, that they don't want as much interest deducted, they'd rather pay monthly or whatever they want, really, to suit them best. We will lend to foreign nationals. Again, on a case-by-case basis, depends on where they're based, and some of that is actually down to the underwriting and how easy it is for them to sign documents and that sort of thing as well. And also on offshore companies, BVIs, etc., we can lend to those structures. That's not a problem. I know a question earlier on as well to Lee about lending to SAS pension trust. We can do that as well, and we don't have a minimum loan for that. But yeah, client obviously has to understand that the legal costs will undoubtedly be higher because there's a lot more work involved in that process. So also we have different valuation models as well at the lower loan to value levels, certainly AVMs, drive-bys, desktops, etc., and also short form valuations. So properties that are less than 500,000 can have a short form val. And also a key point, one of my biggest deal actually last year was on a property owned by a client. It was unencumbered. He was raising money for business purposes. Although we're unreg only, we were able to utilize a high net worth exemption to lend to that client, and essentially it's unregulated. I won't go into the criteria of a high net worth exemption, but it's worth looking it up if you're not aware of it, and bear in mind that we're happy to lend on that basis, subject to meeting those requirements under the high net worth exemption with the FCA, even FSA, show my age. Okay, so one example, just a couple of examples really to run through. Just a property that was being bought at auction, private investor, just needed to get it done quickly, basically, the whole point of bridging, as I've mentioned. And it was a fairly low loan to value, but the particular broker is actually one of mine, it wasn't about rate, which I know is important to clients, but it's not always about having the best rate. In this circumstance, it was about getting that done very quickly, and we did do that very, very quickly, genuinely, and that was one of my deals that I was very proud that we got through quickly. It's all very well offering that you are speedy, and then not. But we genuinely are. We have a great underwriting team. We respond and issue formal terms same day as we receive an application. I provide at the moment my own terms to brokers. We generally get the deal assessed and terms out to you within 2 hours. So we're adept at providing fast turnaround for you to get that deal with your client. I know that's very important to you. Another example really of our flexi loan. So this is not necessarily the discounted one, but just the flexi option where they have the monthly repayments. And it's just a way of getting people a bit more money up front. They had a bit more money towards the refurbishment because the funds weren't all retained at day one. So some of it is serviced, and it was 6 months retained, 6 months service, but they wanted to actually service that loan over the 12-month period. So rather than 6 months at £1,480, it was half of that. So it was more affordable for them to be able to do that. And it's good for us as well. There's nothing wrong with receiving money on a monthly basis on a product. We're very happy to do that. So how does the process work? Well, essentially via Tony, they send a deal to us, is generally how it works. Send a deal to me in most cases. I'll assess the deal against our criteria and issue the agreement in principle to you. And then, of course, it's the application, signed or unsigned at the beginning, doesn't matter to us, but as long as we get the ball rolling, get you the valuation quotes, get you the formal terms, etc. We now use, and this is to speed things up, on ID and uploading of documentation, is an app called Nevo, which has been really well received. And that's for ID verification, so you don't have to worry about doing certification of documents, etc. We can do all that through the Nevo app, and uploading those documents very quickly by the client by scanning and uploading. That has been fantastic. We've also got the legal process as well. We use Title Solve, which is basically an indemnity insurance, title insurance. Again, that's to speed things up. That's on loans up to £500,000, so we don't have to wait the long process of waiting for searches, etc., etc. And it's all about trying to speed things up for bridging, which is what it's all about. So we get the survey in, we assess them very quickly, and obviously set a date for completion. So fairly straightforward process, in all fairness. So I've been talking about the 70s collection. So this is very small on my screen. So we on the 70s collection. So we've tried to get a theme really, and we've sort of done a bit of a retro theme because everything's got a 7 in it. So we thought we'd call it the 70s collection. So we've got the Hope 725 and the Hope 75, and that's just in relation to the loan to value and the rate. So it's still flexible. You can still do servicing on this plan. You're still allowed to do light refurb on here as well. But we genuinely lend up to 75% of 0.74 per month. Minimums and maximums, £150,000 gross loan. Max loan on that is 575 gross. And on the 725 is £725,000 gross. So that's at 72.5% gross loan to value at 0.725. It's, still allows for some adverse on there as well, and you can use it whether it be capital raising on existing asset or for purchase or even rebridge, etc. So it's a really fantastic product. I have to say that at the moment is the product that we're doing most of. It's been very well received. We only launched it to market last beginning of October really, and it's brilliant. I'm told it's one of the cheapest in the market for a straight bridge, and as I've mentioned already, very easy to deal with and flexible. So it's been brilliant for us. So any deals, talk to Tony and the team, happily quote on them. And we've just launched only last week actually. Although we did semi-commercial, mixed use, and also commercial, we've tried to carry on with the theme. So we've got an 80s collection for semi-commercial and mixed use, and a 90s collection, which I'll come to in a moment, as well for commercial properties. And on this product, so we can lend up to 65% of the valuation or purchase price, whichever is the lower. Again, you can service it if you want to, or fully retain, totally up to you. And this is for products that, you know, the usual, so commercial property at the bottom with uppers, flats that are let or to be done up, etc., etc. And that new rate has just been launched up to these maximums, similar to the 70s product. So I'm going to whiz through this because this is information that you can be provided with Tony, but I know my time is tight. And also I've just mentioned the commercial as well. So it's under the same theme. So up to 60% loan to value on commercial. Again, with commercial though, we just have to have a look. We just want to make sure it's not COVID affected too much, as a lot are. And I know as well, hopefully this slide is here. We've got refurb product as well that we launched in beginning of January, and it's got different levels of refurb. So we've got the refresh product, which allows for light refurb, at minimum loans of 50,000 on these products, but you can go up to 75% day one, 70% of GDV, and provide the costs that I've mentioned already in arrears. We've got the next product called Renew, which has a little bit more involvement in terms of what we're doing to the, or what the client is doing to the property, up to 70% day one and 70% of GDV. But this is actually people doing proper refurbs here. This also includes as well, we will, and I know there's a question Shawbrook earlier on about conversions of commercial property to residential, and we're seeing that quite a lot, and that would fit under our Renovate product, where we allow conversions to multiple units, and also heavy refurbs, including two-story extensions, loft conversions, etc., etc. Anything that would need planning is something that we do on here. And that, to be honest, has been very popular. So yeah, conversions, I know the question was asked earlier by Tony, how popular that's become recently. We're getting more and more and more questions about, will we lend on commercial properties with planning, or that will likely get PD, change of use to residential, and we're seeing more and more of it. So yes is the answer. We think it's a real growth area at the moment for investors. I think it's a great thing. Might do it myself. So here we are. The team are available all the time, but Tony will provide you with my details specifically, or via Tony, whichever is Tony's preference. So that's it for me. I'll whiz through it very quickly. Tony will provide you with all the information. Any questions, please let me know. I can come back to you via Tony or directly, whichever you prefer. Tony, over to you.
Steve, thank you very much. We've got no questions from the delegates today, so here's some we made earlier.
Okay.
Where are we? Let's ask the. You've already answered that one, actually. Since the launch of your refurbishment product offering in January this year, how has it been received by brokers so far?
Yeah, well, it's actually been very well received. We did a little bit of market testing on it in December as we were developing the product, and gave it to a handful of brokers to look, give feedback, compare to other product providers that are already in that space. And so we changed a few things that we were looking to do to try and, you know, make sure that it was competitive and provided the right level of GDV and day one lending, because that's always the hardest part. Where do you pitch it? And actually it's been very well received. We've already got deals with applications in, and from every week I'm actually issuing more terms on these. You know, it's going up and up. So you know, the more the word's out there that we're now doing refurbs, and a lot of them are heavy. We're getting quite a few that are conversions. So barn conversions, for example, that have planning. We're getting those through now, which we didn't previously have. So yeah, it's been successful so far.
Excellent. Last question is, how do you view adverse?
Yeah, so as I mentioned already, we do obviously accept adverse, and it's varying levels. So as I mentioned, you know, previous bankruptcies or IVAs are acceptable. We've got different criteria around how severe it is. So the most severe one I had that we actually offered terms on, it didn't proceed in the end, but it was a while ago, around the COVID time. But they actually had £150,000 worth of CCJs across 42, I think, 42 CCJs. So we offered 65% on that. Exit had to be sale for obvious reasons, and that's really, you know, severe. But we have varying levels. It can be a couple of old CCJs from 4 years ago that would probably just ignore. Ultimately, we just want a little explanation. Why did it happen? You know, there's always a reason that someone has had a mishap, and it's happened to many people. So we shouldn't exclude them from being able to borrow money just because they've had a bad time at some point in their life. And most people will go through a bad time in their life and suffer a little bit financially. And we don't want to sort of say no to those people, because that's just not fair. So we're happy to lend to those. Just depends on the circumstances, but in most cases we're very happy to do so.
Excellent. Steve, thank you very, very much
Very welcome.
indeed.
Thank you.
Another excellent presentation, and we are almost bang on time.